We are live. Today is November 9th, and a week ago we closed some record profits on oil. Took 68% profit on NRGU. That's our second time taking profits this year. We also took profits on BOIL with natural gas twice this year, and we're back into BOIL again. If you're watching this video today, you cannot get a better entry point. Our high-risk portfolio total return year to date is at 16.98%. Last year, we did a total return of 233%. Making money this year has been far harder. So we're very proud of that 17% gain. I do think we can at least double or triple that by the year's end. The high-risk portfolio closed a 14% gain in October. It's given most of that back in the last 48 hours. We'll talk about why, but again, I believe that's going to be quickly recouped back to the upside with no changes on the portfolio. If anything, we might put more money into the assets that just had a little pullback after the CPI report comes out tomorrow morning at 6:30 Mountain Standard Time, 8:30 Eastern. Safe Growth portfolio returned 31% in October, one of its best months. We recommend you buy these 5 stocks now. You're going to get great entry points on all of them. Literally all of these are down massively, some of which have been down for 11 months almost straight, and then another which has been down and bottoming for nearly 2 years. Let's go through the trading plan. Now, again, when you upgrade, you're going to gain access to the membership area, and you can type in how much you want to invest up in the top, hit calculate. It's going to automatically tell you how many shares of each ETF to purchase. So on the defensive side, we are buying per unit 19 shares of UVXY, the crash insurance. It's coming in at 9.5% of the portfolio. Again, it's the number of shares per unit. We're not trying to chase an asset allocation. That's going to go up and down wildly every day. Next position, and currently our largest position, which has withstood the latest volatility, is Treasuries leveraged times 3. If you're looking for a safe way to make money in the next 2 years, I can't see a better way to do it than the long end of the Treasury curve. So we'll talk about that a lot as the bond market really dictates all the other markets. You're going to buy 97 shares of TMF. And again, right now, that's our biggest position, coming in at 32%. This is per unit. So if you had twice as much money, which would bring your total investment to $4,060, then you'd be doing double. And again, once you upgrade your membership, you get free access to the calculator software program. Okay, so those are our defensive plays. We're out of the dollar currently. What we're now looking at is the offense. On the offense, we're long Ethereum, the big tech giants, and natural gas. And we're basically going back and forth between natural gas and oil, whichever one's severely sold off, we're buying. And when it goes back towards new highs, we're getting out, not being greedy. We've done this over and over again this year, betting that the local policies plus the war in Europe will create supply chain issues and drive these prices sky high. And it's been really the only way anybody's made money this year. So this will be our second time pulling a profit on NRGU complete. And we're looking at a third time to make money on BOIL. And I think we're going to see those profits roll in probably around March or April. So we're really getting in early right now. On the offensive side, we have 74 shares of the Grayscale Trust ETHE. There's been a massive blowup of the second largest exchange, which is creating a cascading selling effect. This might be your very last time to buy into a bloodbath. And there really couldn't be a larger bloodbath than what's just transpired. So we're at the absolute bottom. Hard to say because we don't know all the liabilities of FTX and its investment branch, Alameda. But I think most of the pain is behind us. And if we look a year or two into the future, you could not get a better entry point. 74 shares of the Grayscale Trust ETHE. Okay, FNGU gives you 12 giant tech stocks. These stocks have been crushed, absolutely crushed due to inflation, which means the bond market was crashed. We believe inflation is peaking out. will slowly fall for the next 3 to 6 months and then rapidly fall, accompanied with massive layoffs. And so this is a great setup for tech and bonds and crypto. Now we know as long as the war is going to march on, there's going to be issues with sanctions, which are crippling supply chains for energy in Europe. And that's why we've been going back and forth between oil and natural gas, with oil companies at very high valuations, near all-time valuations. We've rotated into BOIL currently, 12 shares of BOIL, 4 shares of F&GU. Okay, so tomorrow's a critical CPI print. Right now, the core CPI is expected to fall from 6.6 to 6.5. Of course, every bank has their own estimates. And the October CPI for the headline should fall from 8.2 to 7.9. Now, the headline includes the food and energy, while the other takes it out. But both should be falling a little bit tomorrow, and that's what's priced into market. So if we have a lower inflation, specifically on the services side, that's most likely going to be very bullish. If these inflation prints come in too hot, we could have more volatility in all asset classes, perhaps except the dollar, because this would mean the Fed needs to keep hiking rates aggressively. Other data coming in will be the jobless claims. We want to see that rising, and that's really the core information we're going to be focused on for this month. The next month, we'll be looking at Powell's next speech and interest rate policy decisions. So here's the big battle happening in one chart. Goods inflation led the inflation run up. And if you look back in July, October, we actually had services falling while the goods inflation was rising. Now we've got goods inflation crashing rapidly from a level of 12 to 6, but there's not been a single dent on that services inflation. So until the layoffs really start to hurt the labor market, the services could remain hot and sticky. We'll look at a lot more on this, but that's why I think it's going to basically trade flattish for a few more months before we get it to roll over. Now, this is an interesting chart. This is comparing the M2 money stock compared to CPI. And you can see on the black line, the money stock has crashed, and it's caused all sorts of problems globally. Bond markets, pension funds are just imploding across the entire world. Currencies are being massively devalued, from the Japanese to the Chinese to the Brits to the euro. Everyone is in severe pain. So the Fed's doing this to kill the inflation. And the second they think they've got that under control, they're going to need to ease the tightness. And we're going to see that M2 supply go back up. But as you can see, this is anticipating not only does the CPI fall, if they're not careful, it's going to crash and go to negative. This is looking at the yield curve inverting through history. Okay, so that's the red. Basically, if the red goes below the dotted lines, it makes it very hard for banks to lend money. Just to be very clear, banks like to borrow at one interest rate for cheap on the shorter end, and then lend it out on the long end for a higher interest rate for a profit. And when the yield curve inverts, that doesn't work. So they're going to run out of cash to loan out, and then they're going to stop borrowing. So this is very bad. Anyways, the whole point of this is when the yield curve inverts, the black line, the unemployment rate, rises. So we're expecting that we're going to start seeing the labor market to cool off, and this will be very critical to get those services inflations down and to get the Fed to officially pivot. This chart's looking at the record monetary tightening. So typically, they go back and forth, hikes and cuts at the same time. One part of the world's doing one while the other's doing the other to keep markets from crashing. This year, the inflation was so bad, everybody's hiked all at once. Now, if you look, what happens when you have big peaks in black? Look what comes right after. Massive amounts of rate cuts, and you get those big troughs in red. So we're expecting, we're very near that point in time where everyone's going to have to start cutting interest rates to bail out all their markets. All right, this chart, and again, all of this is basically making the argument that we have peak interest rates, that inflation is in the process of topping out, and is about to fall rapidly. And this is critical for our expectations on how to invest capital here. And it's going to take a little patience, but we don't want to get on the wrong side of this trade. So in this chart, we have the 2-year Treasury yield, and then we have the federal funds target rate. And in general, once the federal funds target rate gets above the 2-year, you're about to have a massive crash in yields. So we're not there just yet, but we've got the federal funds rate at the 4 on the upper bound. We've got that 2-year still insisting on a few more rate hikes. With what it's pricing in currently, we'd be looking at a 50 basis point rate hike in December, then a 25 basis point in the next hike. And then that should do the trick unless these inflation and labor prints come in too hot. So getting very, very close to that moment in time. Now, the best leading indicator to tell us whether the Fed's actions are working or not would be the housing market. And they drove the interest rates on a 30-year fixed mortgage to 7%. So luckily, most of the housing market's locked in at very low rates during the mania, and they're probably just going to sit on their properties. But regardless, what we're seeing is a massive cooling off in the housing market. We're seeing falling property markets globally, everywhere from the US, UK, Canada, Australia, Sweden, all falling off a cliff currently due to these high interest rates. This chart is basically making the argument that one of the biggest segments of the inflation, which is about 30% in shelter, is being misread by the BLS, the folks who make our inflation data. And so they are saying the shelter has this huge inflation rate currently, and it's based on data that has a 7-month lag. When we're looking at real-time data from Zillow and a number of faster data sources, rent is falling currently, going negative. So we're quite certain a huge chunk of the CPI is about to dramatically fall. Meanwhile, we've got to set up technically for a melt up. So first of all, if we look at the average returns during midterms, if we look at the average returns leading from November through April, and then we look at the stock buybacks, and then we look at where investors are positioned with put options, the setup for a massive short squeeze is right there. And really all you probably need is cooling off in the inflation and a little tiny bit of a pivot from the Fed. I think we're going to see that dollar reverse, interest rates fall, and everybody's going to get short squeezed out of these positions. But we have a record outside of the 2008 crisis in the cost of a put option compared to a call option. So the big money can steal a lot of capital from all the put options they wrote by making the market go up. The Fed's balance sheet is finally falling, and it's falling fast. $289 billion gone from the recent high. This is looking at the balance sheet of the Fed over 2002 to 2022. And I just want to note, even though the balance sheet's reducing, some of these years were very positive for equities and making yields go down. So if you look at 2015 through 2018, you had some beautiful returns over that period, despite the balance sheet slowing down or reducing. But what came after that was eventually a massive expansion of credit, almost every single time. So that's what we expect in the future here. One of the big bears this year is actually calling for a big reversal. Mike Wilson of Morgan Stanley. The bear market rally was severely tested last week, with the Fed's clear message that it's far from done. We think it survives again with the midterms providing the catalyst for lower bond yields and higher equity prices. Now on the midterms, it looks like the Senate will remain in the Democrats' hands. The House will barely nudge to the Republicans. Massive letdown for the MAGA fans. And so Biden's almost certainly going to run now. And so we'll see, is it going to be DeSantis or Trump for the Republicans? This is very interesting development. Now, what is happening in certain central banks and what do we anticipate will continue to happen? Everybody's starting to print money to protect their markets. And this is Japan trying to protect their currency. And you can see they've now dumped $63 billion into protecting their currency markets. Here's a look at some of the biggest losers in wealth this year. Zuckerberg down $75 billion. Binance CZ down 67 billion. He's the one who just wiped out FTX with a clever move and potentially will buy them out, looking like their books were so bad that he may not do that. That's why we keep seeing some more pressure on cryptos. Musk down 60 billion, Amazon down 54, Arnold, Page, Brin, and Gates down 44 to $30 billion. So we're saying buy the dip in these monopoly cryptocurrency, tech companies. And FNGU essentially has exposure to almost all of those. The big news in the last 72 hours is FTX has gone bust, 32 billion valuation wiped out. These guys rose money from everybody under the sun, even a Canadian teacher pension fund, for heaven's sakes. And I think we had Tom Brady and his family had almost all their net worth in this exchange. So this is the second largest exchange getting wiped off the planet in a 72-hour period. So the extent of the damage looks like it's now pretty much over. Although I say that, and we got crypto trading Ethereum at 1156, Bitcoin at 16,000. But most of this damage is now priced in, and I think we're going to see it stabilize and continue its extent back up. So what a wild 72 hours in the crypto space. Here's the TLT, and this is really what's going to dictate each cycle. So we were wrong in predicting such a massive crash in the TLT over the last year. But are we going to think it keeps going down indefinitely and the government goes insolvent? Or is it going to be forced back up so the government can keep borrowing money and not drive its interest rates too high? We're teetering towards the interest on US debt being greater than the military budget, which is absolutely insane. My bet is TLT is going to bottom and skyrocket back up and quite possibly to new highs, which would bring us close to 0% rates and potentially record profits on TMF, which is the TLT times 3. Now, Treasury's safe bet. Crypto goes up anywhere from 10 to 30 times faster than the TLT in most cases when interest rates are going down. Not 100%, but many times the correlation is extremely bullish. As far as the stock market, we can go back to the last time interest rates were this high, and the S&P trailing 12-month PE multiple was at 17. Okay, so now again, right after that, the PE went much lower to 10, and we had the financial crisis in 2008. So with that said, I believe we are bottoming out, and we're not going to have a crushed economy that freezes up. Now, as far as when you should go long stocks, assuming we are headed towards a recession or are in one, a lot of people might think you want to buy at the very end of the recession, but the stock market and crypto markets are looking into the future. This 6-example recession chart shows you when stocks bottomed out compared to GDP and payrolls. Bottom line, the blue line, you can see bottoms out way before earnings and payrolls and GDP start to recover. Stock buybacks, about 5 billion a day incoming. That's just an automatic demand structure. And then everybody likes to compare us to the 70s. The best time to buy was in late 74. And it was not when inflation was falling, it was when it peaked out. And that's where I believe we're at today. History of interest rates. As the debt grows, interest rates must go lower and lower. Otherwise, the system breaks. So will they engineer a way to take interest rates negative? That's the big question. And if they do, the returns on TMF are going to be astronomical, as well as cryptocurrencies. So we'll have to keep a close eye on this, but I believe we are very close to peak interest rates from the Fed, and that we're going to see it top out and then fall. Okay, now again, upgrades, you get our trade alerts, you get access to the membership area, you get a custom trade alert. Call Dean now at 505-322-7515. Okay, let's walk through the portfolio step by step, and we'll look at it all one by one. Steven says, why does the, well, so they, as long as the House is taken over by the Republicans, it's going to freeze the budget, which means less inflationary pressure. So that's all we really wanted for the way we're positioned. So unless it was all democratically run, we wouldn't be worried about more damage to the bond market. Now, as far as being scared out of oil, if we had the Senate and House replaced, and that would give us a good idea that perhaps the Oval Office would too, then the expectations for supply of oil in the US would most likely reverse. And I'd get you out of, or I'd be very scared to enter NRGU at these levels. So a split Congress is very good for the bond market to heal here, because it's going to slow down all the spending, and we may stop supporting the war in Ukraine, which is again a major cause of inflation. Okay, so Ethereum down 62% year to date. One of the worst drawdowns in its history. And I say buy the dip. The structure of debt globally is not going to change. They will drive these rates lower. It's the only way they can keep operating. So again, it's been ugly, but I do believe we're going to see much, much greater highs because governments want to spend more money than they have. ETHE doing a little worse, down 70%. But just keep this in mind. The short-term price is one thing. The long-term price is completely different. And so there's going to be an unlimited amount of dollars printed over time. There's only 21 million Bitcoin, and there's even less Ethereum, relatively speaking, because it's actually shrinking in size over time. And this is just a reminder of debt over the last 50 years. They can pull it back for a year or two, but they sure don't stop growing the debt, do they? That's really all that matters in the long run for crypto. Here's the US budget deficit projection. This is assuming they don't do any more shenanigans to rob the people like they did with the lockdowns. And it's going to grow from a cool trillion deficit to 2.3 in 2032. Now, if interest rates stay at this level, it's going to be way worse than that, which is why they won't allow it to occur. And we're going to look at the most recent times that we saw a TLT rebound and what happened to crypto. With the TLT currently down 40% from the 2020 high, the potential for a sharp reversal is gaining momentum as inflation tops out and is likely to start falling rapidly by mid-2023. There's that TLT chart, which means interest rates are rising. Most recent 14% gain in the TLT from April 2020 through December 2021 led to extreme cryptocurrency returns. TLT went up 14% in this period. Ethereum went up 114%. It had a big run up, gave back the gains, and then skyrocketed back up. Now, if you are a member and you want a more advanced cryptocurrency position, reach out to us about Rebel Dividends. We're going to be investing in not only Ethereum, but the top applications being designed on Ethereum. So think of Ethereum as something like Windows, and Matic is something like Adobe Photoshop or something like that. Now, again, the exact use of Polygon, ticker Matic, is far different than Adobe Photoshop, but it's essentially an application designed on the Ethereum operating system. So you're going to make a lot more money on these low market cap applications that are just being born right now compared to the operating system itself. And as you can see, over the same period, Polygon went up 525% with a very similar chart as Ethereum. Sand went up 900%, didn't make a move till the very end. Mana went up 350%, very similar chart as Sand. Other coins that we're currently investing in made their rally before the big moves. We can see Link went up 400% before much of that move began. Uniswap went up 780%. Aave went up 900%. And Curve went up 310. And these are the top apps based on market cap, which is how we select our portfolio. So the potential for the TLT to make a move is far greater than 14%. This is the biggest bond crash in history and the fastest tightening by global banks ever recorded. So not only is inflation likely to top out, it's likely to fall fast. And that's when you really want to be positioned. So looking at the Bitcoin cycles, assuming the bond market crash is bottoming out, we're getting ready for probably the most amount of total money flowing into cryptocurrencies in history. Now, that doesn't necessarily mean the biggest percent return, but we're probably going to see the market share hit a record high, and it's probably going to top out somewhere in 2025, and that's just based on the bond market cycles. Okay, next play is commodities. This is our war hedge or our climate change agenda hedge. Basically, if you're pushing for climate change agenda, and that is gung-ho, then you want to be long the big oil and gas companies that are allowed to make money. All the little guys are being blocked. So NRGU gives us those big, giant, monopolistic oil companies that are partnered with the climate change folks. And then we want to be long natural gas. So we're going back and forth, and that's the only thing that's made money this year. Oil is a beautiful buy right now. Currently, the storage levels are just completely full, which is when you're going to get the cheapest price. And that's really been our strategy over and over again. So what's this war about? Russia has $75 trillion worth of resources, and the US would love to control those. This is look at US military bases around the world. And so we really run the whole show. Now, this is important because it would make me want to hold NRGU if it was different. EU sanctions on Russia, where they're going to price cap Russian oil, starts December 5th. But it's exempt from oil from Russian ports that are of a foreign origin. So keep making these sanctions that are easily scooted around. Now, also the midterm election is over, and so the necessity to keep dumping the U.S. strategic oil reserve is about to slow. So I think we're about to see commodities go back up, especially if you get a pivot from the Fed. This is looking at operating income from Apple compared to Exxon. And so in an interest rate rising environment, you can see Exxon is just killing it, catching up with Apple's net income. Unlikely to last, but that's currently the situation. And it took a very, very interesting set of circumstances for them to pull that off. We basically had to kill all oil production in the US, giving the ones that are already operating a complete monopoly on the supply we have, and then go crush the supply in Europe and get these sky-high prices. So it was definitely designed to do this. All right, so here we got gas storage levels in Germany, record high. That's your signal to buy the dip, because what's going to happen, these are going to get drawn down and price is going to go up. Super simple. So unless we're about to have a peace deal with Russia, this is a great play. If we are going to have a peace deal with Russia, we're getting the hell out of oil and NRGU and rotate it into Bitcoin and Ethereum, because that's going to be an extremely bullish event when there's a peace deal. We do have Russia evacuating Kherson, and we have Zelensky talking about peace and rumors that the Biden administration wants them to negotiate. So is there a peace deal in the works? We will see. All speculation currently. Goldman Sachs predict, these guys are all over the place, but just some analysis looking at $100 oil for the rest of the year. And again, not going to see the U.S. change its policy if the Senate is held blue, but we could get some more supply coming out of Russia if sanctions are reversed and a peace deal is created. So that's why we got to be careful about that news. Okay, one of the things easing energy costs is about to end, and that's dumping the strategic petroleum reserve, which is now at levels last seen around my birthday, 1985. Now, in the 2005 to 2008 run-up, the energy market was 16% of the stock market. We're only at 5%, and we already got Exxon at all-time valuations. So I'm not saying it's going to go that high, but there is still room if energy costs are kept at these extreme levels. Okay, so we have basically waited for around this price. Well, first we got in February after selling our oil position because we saw that there was a war about to break out and understood Russia would likely cut off gas to put pain on Europe. We sold not at the top, but near the top. And then we got back in July, approximately, rode it back up, sold it, and now we got back in. And it's been a wild little monkey jumping up and down on us. A lot of volatility. We've had up and down days, plus minus 10 to 15% back and forth. But rest be assured, unless a peace deal is about to be brokered, these prices are going to go up and they're going to run out of gas because they're having to import it from all over the world outside of gas, Nord Stream 1 and Nord Stream 2, which are obviously blown up or not working. So here's Boyle, and this is our best war hedge currently. There's NRGU, which we just got out of around 580. It went as high as something like 630. So another beautiful play. We'd sold in February after holding it all year for a nice profit. Obviously, it ran up much higher, but we were running Boyle at that time. So we've been doing very well with commodities all year, just buying at low prices and selling high. Here's a look at the price of oil, sticky at 92. What's going to happen when they try to refill the strategic reserve? Unless Russia's 2 million barrels are allowed to flow freely, or the U.S. is going to increase supply, these prices are going to remain sticky unless the entire economy is destructed by the Fed. And I think the Fed's about to pivot or slow down rate hikes. So sticky oil ahead is my most likely outcome until something's fixed. Here's Exxon at sky high valuations, 111, which is why we're out. We're not going to just try to ride this indefinitely. Peter Zahan believes Russia has much grander desires than taking over a part of Ukraine and believes that all these countries are their target. So far, they are not having a lot of luck, obviously. They are mobilizing 300,000 troops, but they just abandoned Kherson. Now, are they inflicting massive pain on the world? Yes, absolutely. So at this point, I don't see a peace deal, and I see this escalating into next year. So that's why we remain long Boyle, and if we get a cheap NRG, we'll go long that too. Crash insurance, this has been a dud. It's going to take a massive collapse to get it to really take off. Here's NRGU, UVXY. Here's why we buy it. If you get a 25% decline in a single month, like you did in the S&P 500 during the March lockdowns, say a tactical dirty bomb or nuke goes off, say the inflation keeps rising faster than we think, and the US bond market falls off a cliff below where it's at, say the Fed's just nuts and keeps raising rates 75 basis points for the next 3-4 meetings. You could do it. You could absolutely freak everybody out and get that level of a crash. So haven't really added to that for quite some time. It's been holding its ground. And this is the 2008 analog to the VIX today, showing even though we haven't had the action, we certainly could still. A dollar at this level has caused all sorts of problems globally, but I believe those problems have been already priced in, and now my expectation of the dollar will fall, interest rates will fall, and the Fed's going to have to start to pivot here. Okay, the bond market. Here's a breakdown of the consumer price index. The shelter's the biggest piece. Absolutely, that's going to top out and fall. We know this for sure. Housing market has collapsed. Loan origination mortgages are down 90%. They're laying off the people who do the underwriting. Housing prices globally are falling, and now rent prices are falling for about 2 months now. So the way they're measuring it is way back 6 months back. So that's why it's going to be sticky and then fall. Food's already falling. Energy is down, but sticky now. Medical care costs are falling rapidly. So it's the services that's really sticky now. So that's why we're expecting it to kind of trade flat, maybe slightly down, and then fall aggressively next year. This chart's looking at inflation. Green is energy. It led the rise in inflation, and now it's falling negative. Now we're looking for the blue services to start basically lagging behind the green energy. Bank of America believes we will see payrolls slow down and go negative next year. That will certainly kill the services inflation. And then the household net worth effect. So if you look at your value of your stock or pension account or your 401k, it's worth a lot less than it was to start out the year. So you're going to start conserving money. That's going to slow down that demand. And this is really the policy tool the Fed uses to control supply and demand, or not supply, but the demand for supply. Okay, TMF, this is the play we think you're going to make a lot of money on with the least risk, because it's backed by the US government, and we believe they're going to want to keep spending money they don't have without growing interest greater than the military budget. Only way is to drive those interest rates back down. So it's a leveraged play on the TLT, and 160 was nuts. We literally locked down the whole world to get interest rates that low. It'll take some sort of engineered crisis to probably break that. I'll be happy to start taking profits on TMF when the TLT is getting back towards probably 150. I don't know if I would hold on to it to the 170 level we saw at the peak, which was near 0% rates, unless, again, there's some sort of crazy crisis that is engineered. Okay, the other bond markets are not down as much, so that's why we want to invest in the one down the most leverage, and potential action ahead. So LQD, investment grade, only down 10, HYG down 6. So the stock market is predicting we're about done with this. Here's the 3-month interest rate, way above the last high, nearly at the 2008 high. And again, it can go up, then it flattens and crashes down. Here's the 2-year at 4.6, 4.64. So that means we've got so far the 2 years telling the Fed you need to hike another 50, another 25, and you'll finally get us over the 2-year, which usually marks the top. There's the 10-year. You can see the trend. Again, now, unless we think we're going to have a 60s to 70s period, likely the downward slope will continue. And the key there is looking at deficit spending. If deficit spending is going to continue at these levels, interest rates must go down. Otherwise, it won't happen. There's the 10-year rocketing up to 4.1, which again is lower than the 2-year. So we get that inverted yield curve. There's the 30-year going way out of trend, likely about to get crushed lower. Italian bonds topping out. Some of the inputs that can lead the inflation: lumber futures down massively, 65% decline this year. Copper futures starting to pick back up on the rumors that China would reopen, but they quickly walked back that. Baltic Dry Index is down 40%. The cost of commodity shipping between continents. Wheat futures are down. So I believe the CPI is topping out and going to fall rapidly. Initial claims sitting at 220. We'd like to see this rise to 300, and that would probably give the Fed some comfort that they've cooled off the labor markets. That's your inverted yield curve, which typically signals peak interest rates on the long end. And now we've got the federal funds rate almost above the 10-year, which typically results in a pivot. Okay, we're not in the dollar right now because I think we're about to pivot. We did very well with being long the dollar, and it's crushed all the other currencies. Get ready for the reversal. Watch for the dollar to fall for the next 2 years, and for assets to rapidly rise. Here's the yuan getting crushed. Here's DXY. I want you to note, as the US debt grows to bigger and bigger levels, the valuation of the dollar peaks out at lower and lower levels. And the lows in the value of the dollar keep sinking lower and lower. So the amount of money we'd make in crypto if the DXY went from 110 to 90 is massive. But picture it going to around 70 to 60. which is the level we saw in 2008. And so Bitcoin, which has gone up some 3 million percent, has been in a period of a strengthening dollar from 2008 when it was formed to today. So just imagine the valuation of Bitcoin when the dollar index is in a period that's more like 2000 to 2008, falling off a cliff. And you need rising interest rates to fall for this type of environment. Here's EUO, long dollar versus euro, 28% year to date. The euro's been devalued 13%. The Japanese yen is down 26% against the dollar, and the Chinese yuan is down 13%. Russian ruble is outperforming everything, 23%. And again, just showing you higher, lower highs over time, again, as US debt grows, and much lower lows. In fact, we can see in 2008, the dollar hit 70. Okay, FNGU screaming buy. When you get this type of decline in stocks, it's at the absolute bottom. Maybe, maybe not, but a year, 3 year, 5 years from now, you're making massive gains. So we're long FNGU, leveraged tech stocks ×3. And these are just the big, giant monopolistic ones. Okay, let's look at the indexes. The SPY is down 18% year to date. The NASDAQ is down 29%. Emerging markets are down 26%. This chart is showing you that emerging markets and US markets take turns each cycle in outperformance. So we actually think emerging markets, as soon as interest rates are falling and the dollar is falling, will dramatically outperform the US stock market. In our safe growth strategy, we're playing that with EDC. In our high risk portfolio, 2 of our companies are Chinese tech giants in FNGO. Now, if Europe's about to collapse and create contagion, similar to what Germany did after World War I, which is where everybody wanted reparations that they couldn't afford, and it collapsed their currencies, and it eventually led to the Great Depression. Well, this would be our canary in the coal mine, EFA selling off far worse than other markets. So far, that's not happening. So we're keeping an eye on that. Some of our older plays that we're not in right now, uranium, rare earth metals, RAMX, we're not in. So lithium for climate change and for electric batteries, and then uranium for a new energy source to replace coal and oil. Not in those yet, we'll probably be back soon. Okay, Amazon down 46% year to date, Apple down 20%, Alibaba down 49% year to date, and down just about as much last year. So we believe it's a great time to go long tech, predicting inflation is about to peak. Some averages of returns. If you pick the bottom of a midterm and then go to a year later, average returns 33%. Okay, this data we'll have updated next week, so I'm going to skip through it, but all the data looks pretty healthy as far as retail sales, exports, imports from China. So we're not having some sort of economic collapse right now. We're just trying to cool off a very strong economy. Okay, don't miss our next trade alert. Call Dean at 505-322-7515. And this is where the video ends, unless you upgrade. I'm going to go into the membership area, look at our returns, our exact asset allocation for both strategies, and go from there. Okay, so let's look at the damage. We're down 7% in November for safe growth, down 19% on the year, so we're about even with the S&P 500. Market goes up, we're going to just kill the returns of the S&P 500, which is what I expect to be the next move. High risk gave up its whole return in October in a day or 2 days. But I'm extremely confident the 2 assets that are down are not just going to go up, they're going to skyrocket up. So I'm ready to move some of our treasuries into the more aggressive play, considering it's the high risk portfolio. So possibly tomorrow, we're going to dump some treasuries and buy the dip in BOIL and Ethereum. Balls to the wall. Let's make some really nice returns to close out the year. Okay, great. So I'm gonna go ahead and do questions and get you guys out of here. We got the CPI at 6:30 my time, 8:30 Eastern, and I might do a trade alert. Harry, I'm about to buy more Ethereum. So the further it goes down, the better the buy it is. Now, if you want to realize a loss to offset your Boyle gains and then invest in Rebel dividends and get super leverage, then that's an option as well. So call Dean for that. No, Grayscale Trust doesn't have risk, Sean. He's wondering if the Grayscale Trust has some sort of risk. No, they just hold Ethereum and they do it with no leverage. So really safe in that respect. The greatest risk there is you're at the whim of the market to dictate the valuation, and they take 2% a year. So it's trading at it's underperforming the real assets. I would highly recommend anyone who owns ETHE or GBTC, sell it and send those funds to us to be managed for far better returns on the upside, because you can get those altcoins. Yao says, what will go up bigger? Well, treasuries can go up if stocks go down. If we have a healthy recovery, a soft landing, and the economy, let me just rephrase, if the Fed doesn't let's just say this, if the Fed slows down the rate hikes, I believe we're going to see FNGU outperform TMF 10-1. If the Fed's going to overhike and crash the whole freaking system, treasuries still make money. I don't see an outcome where treasuries don't make money. I think TMF will make money no matter what with a 2-year time horizon, regardless of what the Federal Reserve does. But yeah, most likely high risk will dump treasuries and go long Ethereum and Boyle and maybe a little FNGU if the inflation data looks decent tomorrow, which would give some ammunition for the Fed to do the 50, the 25, and then stop. Jody says, can you explain reverse stock splits? So yeah, if the stock gets too expensive, like it looks too expensive, they can do a split. So let's say it costs $100, they do a 10-1 split. Everybody now has 10 shares instead of 1, and they cost $10 each. Now let's say the shares get too cheap and it looks like it's a penny stock. So they're like, no, let's do a reverse split. Now we're going to do a reverse split 10-1. The $10, your 10 shares at $10 turns into one stock worth 100. So splits and reverse splits make no difference to the valuation. It only changes the perceived value of retail idiots who don't understand that you're not changing the value of the asset. So I don't pay too much attention to that other than adjusting our calculator for it. A lot of big tech giants like to keep the price point low so that retail investors can afford to buy out of the money call options. So we do like to see them targeting that price point that attracts retail. Steven says, can inflation ease even if oil skyrockets? I don't think oil is going to skyrocket, but remain sticky. Yeah, the only thing that really concerned me is oil going above 110, 120 again. And then I would think we're going to get a big crash. So yeah, tomorrow we got important CPI. So we'll be ready to respond to that. If you're in Rebel Dividends, you get your dividend on Monday and your live webinar Tuesday. We'll be back Wednesday for Portfolio Builder. So thank you guys so much. Hang in there. This inflation is going to come down. We're going to be all right. Just stay tight. We don't want to make the mistake of thinking inflation will just go up forever, because it's not. Gary says, what if the oil supply dries up in the US? Not gonna, yes. So the big oil and gas companies, I think, are mostly drilling offshore. I'm not too worried about that. I'd be worried about the price of oil going too low. We have massive amounts of oil in the US. It's not going to dry up. James says, will the government want to crash to get CBDCs? Well, the Democrats now have the Senate and the Oval Office, most likely. So they look good. So I don't think they want to go crash everything. I think they're going to want to pump the markets up and try to put Biden into office for another 4 years. And so, yeah, the Democrats aren't going to change a damn thing. They're going to keep pushing the same agenda. It's working. Look, they just slaughtered. With what the economy is doing right now, it should have been a brutal eye opener for the Democrats, and it wasn't. And now Trump looks horrible, and potentially DeSantis is going to come in. Paul says the difference between sell and sell short. So if you sell, you're just getting out of your position. If you sell short, you're actually going to borrow someone's stock, pay an interest rate, and then you're and then you're going to try to buy it back later at a lower price. So if you sell short, you're paying a daily interest rate that's usually extremely high, and let's say it costs $100, and let's say you sold short one share. If the stock goes to 110, you lost $10 plus the interest. Now let's say the stock went from 100 to 90, you made $10 minus your interest. So short selling is a very difficult game. If you short sell a stock at 100, it goes to 300, you lost more than you put in. You lost $200 plus the daily interest. So when you hear about big hedge funds trying to short some of these little shitty old companies, and then you get the retail mob just scanning for that, and they all go buy the junk company, it causes these hedge funds to lose massive amounts of money, and the only way they get out of the position is to buy the stock, which makes it go up even faster. It looks like Binance is not going to bail out FTX, and that is now priced in. John says, unless you're Citadel, yeah, then everybody starts freezing the accounts, limiting stuff to help them get another position. Great questions today. Yao says, should we alter the trading plan? No, follow the trading plan. Okay, guys, thank you so much. We will see you back on Monday, but I might do a trade alert for high risk. I like the way Safe Growth is set up. I want Safe Growth to have that safe bond position, which I know for sure is going to make us money. High risk. We just had the second largest exchange blow up and wipe out 200 billion market cap in 24 hours, 48 hours. We want to buy the dip. We want to buy the dip and take advantage of that. And we've had some volatility in BOIL. So we might top that up a little bit too. Okay, guys, thank you so much. We'll see you back with a